Concerns about supply risks and a rapidly escalating conflict after Iran's weekend attack on Israel offset data showing China's economy grew faster than expected in the first quarter. And with more evidence out this week suggesting the Fed is unlikely to rush to cut interest rates, the prospects for oil demand don't seem so strong. Well, to help analyse all of this, I'm joined by Viktor Katona, Head of Oil Analysis at Kpler. Victor, thanks so much for joining us. Well, let's start with the tensions in the Middle East. Were you surprised that prices haven't really advanced more since those attacks in the weekend?
Well, there certainly was a great deal of anticipation before the weekend. Everyone knew that Saturday and Sunday would bring some kind of a resolution. I think the market was effectively disappointed by what it saw. It expected a World War III styled a battle, but none of that really happened. And right now, effectively, a couple of days after that retaliatory attack by Iran, what we see right now is that the likelihood of a larger regional conflict is off the agenda. And with this, effectively, Brent is back to trending below 90, or at least hovering around that area. And I think that's where it would stay. Effectively, the fears that this attack could lead to a conflagration in the Middle East are right now no longer that pertinent.
Now, we all know that China is the world's biggest oil importer, and today's GDP number was quite impressive, way above expectations. So why did it not have more of an impact on oil prices?
I think the market still doesn't believe that China could effectively pull off a year when it consistently delivers on what the market expects. Because a lot of people expect China to be still stellar. It won't be stellar. I mean, 2023 was the rebound year. This is just incremental growth in 2024. But also there are a lot of naysayers who expect that China will implode or will collapse because the construction sector is so weak. I mean, they are wrong too. So effectively, we should adapt to China being no longer a stellar performer, but modeling through adding a couple of 100,000 barrels per day this year or next year, but nothing extraordinary. So China has been doing quite well. Even in its oil demand has been quite good. Its oil imports have been increasing literally every single month this year, 4 consecutive months of growth. So I think China is not a bad story. It's just nothing extraordinary and no longer the pace of growth that it had before the pandemic.
Now, last week we heard from the IEA. What did you make of what they had to say about growth in the world's oil use?
I think it's increasingly difficult to understand where oil demand would actually be, because the rift between the two camps, really, the ultra bullish and the ultra bearish camp, is getting bigger and bigger and bigger. I think as a guideline, use the statistical average between the two, and that's roughly where we will be. Most probably, we won't be as negative as the EIA expects. Most probably, we won't be as strong as OPEC expects. But in the grand scheme of things, I think oil is one of those commodities that in 2024 will still perform quite nicely, as opposed to a lot of other commodity sectors which are under pressure. Oil is looking good, and the summer is looking particularly nice. So there's a lot of bullish momentum going on right now, I would say.
Now, on Thursday, the Biden administration will decide whether to extend the 6-month sanctions waiver on Venezuela. What are you expecting, and what could the impact be?
Well, personally, I expect that the sanctions waiver would be extended for another 6 months. And the real reason why I expect this is not because President Maduro has shown some great readiness to accommodate the wishes of the White House. I mean, effectively, nothing has happened on the political track. But in real terms, if the Biden administration goes for a sanctions snapback, I mean, we don't have Brent at 90, we have Brent at 95 at least. And that's a huge potential risk. I mean, inflation is already a problem for the Federal Reserve. Imagine if oil prices start climbing towards 100 again. And the only reason why this would happen would be the sanctions setback on Venezuela. So, that risk is very painful potentially for the US economy and the politics as well. Most probably they don't want to do it right now. I mean, let's have it in November, December 2024, when it no longer matters.
Now, Victor, you've given us an idea of where you think oil prices might end up, but just to summarise, where do you think they might peak in 2024?
I think the summer is looking particularly strong, particularly tight, because demand is effectively across the regions. It's either stagnating, as in Europe or in the United States, or it's growing very nicely, as is the case with the Middle East and Asia. So I think 1995 going into the summer, potentially peaking somewhere around those mid 90s. And then effectively, slumping back to what we have right now, the 85-90 range in the second half of 2024. I don't think we're going to have triple digit. That's the one thing that I don't really is going to happen unless there's a huge geopolitical conflagration. So unless we have a war, it's going to be a nice and sustainable $90 per barrel.
Viktor Katona from Kpler, many thanks for your thoughts.